The biggest macroeconomic news of the week comes in the form of the UK unemployment and wage growth numbers. They are due on Wednesday the 18th of July and they'll actually be the figures for May. Now remember that in April, unemployment stayed put at 4.2%, the lowest rate in 43 years, but wage growth still stayed cool at 2.5% year on year, including bonuses. Now at least wage increases stayed marginally ahead of inflation, which is a good thing for consumers' purses or wallets, and from an investment perspective, it might bring a little sunshine to areas that need it. The first chart shows how real wage growth, that is wage growth minus inflation, compares to the FTSE All-Share General Retailers sector. This next one shows the same real terms year-on-year wage growth figure against the FTSE All-Share Travel and Leisure grouping. Now, we all know the past is no guarantee for the future, but if history does prove to be a reliable guide, then improved real wage growth could help if either wages accelerate or inflation cools, and a fresh deterioration could hurt. Now, whether it would then help or hurt bricks and mortar or online or multi-channel retailers more or less would be up to you to decide if you're one of those intrepid investors who likes to pick their own stocks. And talking of stocks, there's a good smattering of corporate news flow due in the days ahead, with a number of FTSE 100, FTSE 250 and AIM quoted firms due to release results, publish a trading update or host their annual general meeting. They include EasyJet, Severn Trent and TalkTalk on Wednesday the 18th, Halma, Royal Mail and SSE on the 19th, when we will also hear from AIM quoted Nichols, which makes Vimto. It'll be very interesting to hear the fizzy drink makers' take on the carbon dioxide shortages. And finally, we have HomeServe on Friday the 20th. However, the company most likely to cause a fuss in the week ahead will be Unilever, when it unveils a first half trading update on Wednesday the 18th of July. This is the latest chance of the Anglo-Dutch food to personal care and hygiene giant, which owns Knorr, Ben & Jerry's, Marmite, Magnum, Persil, Dove, Domestos and many more. And it's the big chance for it to show that it was correct to spurn last year's £40 a share bid from America's Kraft Heinz. Unilever shares have advanced nicely this spring, helped by a confident first quarter trading statement, the promised sale of the spreads business and, perhaps, the completion of a €6 billion share buyback programme. As a result of those three factors, the shares are trading now above the putative American offer price. So far so good for Chief Executive Paul Polman, who will now be looking to show the company is on track to deliver on his medium-term financial goals, namely 3 to 5% organic sales growth a year and an operating margin of 20% by 2020. As such, the key numbers to watch in the trading statement are as follows. First, the sales number. According to Unilever's very helpful investor relations website, the latest consensus analyst forecast for revenues is €26.5 billion, down nearly 5% year on year thanks to currency movements and disposals. However, the key number really is the underlying growth rate in sales and how it compares to Unilever's 3 to 5% target. After a bit of a lean spell, Unilever got there again for the second quarter in a row in the first quarter of this year with a 3.4% advance, though analysts expect to dip back to 2.2% in the second quarter. This next chart shows the underlying growth by quarter over 5 years with a black band showing the target zone. After that, look at the mix in sales growth between prices and volumes. Unilever achieved its first quarter sales growth with volume growth of 3.4% and prices going up just 0.1%, which is interesting in the context of 2016's dispute with Tesco over the price of Marmite, for example. Finally, Unilever will probably comment on profits. The consensus is for headline operating profit of €4.5 billion, with an underlying number of €4.8 billion once you adjust for some restructuring costs. These figures compare to 4.8 and 4.9 billion a year ago, though those numbers included spreads. More importantly, the underlying operating margin is expected to be 18.3%, tantalisingly near to Mr. Polman's 20% target. Thank you for watching, and I look forward to seeing you next time.